Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. As global share markets continue to bottom out in a period of severe market turmoil, my next guest, Mathan Somasundaram of Baillieu Holst, says that global investor pain is in fact local investor gain. He joined me today to discuss some of the opportunities and yield plays that remain in the Australian share market. Mathan, many thanks for taking the time to chat with Dukascopy TV again today. A pleasure to receive you.
Not a problem.
So, ASX performance, I think volatile would be a fraction of an understatement to highlight some of the recent performance that we've been seeing in recent trade. Are you seeing a turnaround at any point really in the near future?
I think so. I think we're getting to the point where the downside risk is getting a lot less and the upside risk is potentially increasing a lot more, because the biggest selling pressure comes from, obviously, with China devaluating their currency and Australia being such a commodity-based country. The market expects that to flow through and expects our currency to devaluate quite a bit. So in that which I agree, which we've been expecting, and I think the overall market has been expecting for a couple of years, but this could actually make that happen faster than expected. And so the global investors who potentially could see the global selling as well as the currency hit are taking the first step and just jumping out, which is obviously we had the bank capital requirements come in as well, which is, our banks are about 35% of our index. So that took a big hit in the market. And then on top of that, with the selling, we've actually had a decent correction come through. So investors who couldn't jump in are looking at stocks now, good 10, 15% lower in some of the other cases, maybe even bigger cases. So I think you're getting back value, and people who missed out are getting another shot at buying it.
Now, you recently suggested that global investor pain is, in fact, a local investor gain. Can you expand on this theory for us?
Sure. Look, global guys, they do have the two-pronged risk. You've got the equity risk and you've got the currency risk coming into it. So really, they're looking at it saying, well, we've got this currency risk, which is going to flow through from China, which is almost certain to happen. And as that happens, and especially when US Fed puts up interest rates, assuming they do, that'll flow through as well. So that will devaluate the Aussie dollar. So when that happens, as a global investor, when you take money out, you're going to lose out on both. So they're rushing to get the money out, which has had a sell-off in our markets, and we're seeing substantial value. For the local investor, it doesn't matter what the currency is. So really, people are willing to buy, if you look at our best bank, people are willing to pay $90 to $100 for it. Now it's trading $70 to $80 in that range, so people can jump in now at a substantial lower price, which has already taken into account all the capital requirement risk, and get in and get a good yield return. Because at the end of the day, global investors, once the currency stabilizes, will come back to Australia because we still have a very high sustainable dividend yield coming out of our equity markets. And in a global sense, that's hard to find.
Are we seeing then broader opportunities then for those yield trades? Banks are still looking to remain a great yield play. Gold also seeing a lot of interest.
Yeah, gold has become interesting because, the biggest reason it got sold down because there's no inflation around the world. Now, if you look at the risk now, gold might actually come into play as a deflationary protection. A lot of people have taken money out and they're holding money out of the market or the property market. In China, you've got both asset bubbles. They've got a lot of money sitting there. If they hold the currency is devaluating. So in theory, they're losing money just sitting in the bank. So if they turn around and buy a commodity like gold, they're able to protect themselves against devaluation of the currency. So it's beginning to play in a number of space. So holding cash is not as safe as it used to be nowadays with so much printing going. So in that context, gold is coming into play. You still got interest rate hikes. So in context, emerging markets could see a lot more growth risks coming through. So if US Fed does move, again, that is a question. If they do move, then there's more risk for emerging market. China is likely to devaluate even further, which is more risk for emerging markets. So there's a lot of currency risk sitting in those areas. And most of those emerging markets tend to jump into things like gold to protect themselves with currency risk. So that's actually playing well. And with the markets, a part of the market is psychological. And so when markets panic, you throw the baby out with the bathwater. So you've got pretty much every stock getting hammered, even gold stocks when spot gold is actually moving up. So it's kind of an interesting one. So you can actually buy someone like Telstra who doesn't have any macro negativity attached to it or any capital requirement, and it's paying over 6% yield, back down to $6. So you're beginning to see more and more value come back to the stocks. So there are, I think there's good value hunting in healthcare sector, good yield growth plays in the telecommunication sector. And I think in the mid to small cap space, in the industrial space, there's a lot of global companies that are doing quite well. And those guys have all come back with the market as well. So you're beginning to see good growth ideas in the small cap space, back 10, 15, and 20% lower than what they were 2 months ago. So there is a decent amount of value and yield out there. So investors now can pick and choose. So some people have held some stocks that have underperformed for a long period of time. This is a good time to sell that and buy some other quality stocks that are pulled back.
Well, that does lead me to my last question. How then are you seeing investors positioning themselves for sort of the second half of 2015? Or is it likely to be sort of a more all to play for scenario if and when the US Fed does take that opportunity for the September hike?
Yeah, it's interesting because you've got two sides of the argument there. One, they're probably scared at the moment. It's natural. When markets are falling, you've got a 10% correction and the world looks a scarier place. People tend to cash out and wait and see. So that side of the investors potentially going to wait and see what happens with US Fed and what happens with China. And so in the next couple of weeks, you're going to see a lot more volatility and probably for a month. The other side of the coin, investors who want to jump in and pick up value will buy some now and wait and see what happens with the market. And I think it's almost inevitable that China will throw out some domestic stimulus to get their domestic consumption going. So that should support things. And so when that move happens, then you'll see more and more buying. So it is a momentum play at the moment. But look, you can't blame anyone for panicking. It's a natural thing. But if you look at what the index has done in the last month, if you look at it over the last 10 years, apart from GFC, this month is the biggest decline. So if you look at GFC and you say, look, US blew up, China had negative growth, Europe blew up, we're not seeing that. We've got US in recovery, China is slowing down but still growing, Europe bottoming to a certain extent. So in context, the world is a much better place. Everyone has much better balance sheets. So in that context, I don't think this is a GFC. So if it's not a GFC, there's going to be a turnaround. Do I know when that's going to happen? No, but I know that we're pretty close to the bottom. So I'd be buying some now and buying gradually over the next couple of weeks. So as the market turns around, you're not going to miss out too much.
Mathan, always a pleasure to receive your insight. Thank you so much.
Not a problem.
That is all we've got time for, but our many thanks as always to Mathan Somasundaram of Baillieu Holst for his comments today. I'll be back with plenty more exclusive interviews for you right here from Sydney, Australia. For now though, it is goodbye.